Welcome back to Ben's Book Club. Today we are diving into the book, The New Money Strategy, the modern guide to rational, long-term investing to see how we can build real wealth in today's chaotic markets. This explainer is going to cut right through the absolute noise of modern investing. We're unpacking a strategy specifically written for the new generation of investors, those of us who are just trying to figure out how to put our money to work without falling for the endless hype we see online.
Here's a quick roadmap for today. We'll be hitting the TikTok finance trap, mastering psychology, the passive foundation, hunting for bargains, and finally, the moat tests. Let's jump right in.
Section 1, the TikTok finance trap and overcoming the hype machine.
Look, we have to acknowledge a massive problem younger investors face today. We are constantly bombarded with get-rich-quick schemes and meme stock casts all over our social feeds. And it really leaves us with a stark choice, doesn't it? We can either chase the instant gratification of day trading, or we can embrace a proven, systematic approach to compounding our wealth. The author points out that reacting emotionally and just buying whatever happens to be trending on Reddit or TikTok is literally exactly how you destroy your portfolio. It's treating the stock market like a casino for a quick dopamine hit rather than building actual financial security. Rational investing is the ultimate antidote here. It's built on patience and rigorous process, not gut feelings and FOMO. It's all about shifting that mindset from I want to get rich by next Friday to I am guaranteeing that I'm wealthy 10, 20, or 30 years from now. Now that staggering number, over 1 million, actually represents the YouTube subscriber base of the author Brandon van der Kolk. He's distilled years of teaching into this 288-page manual. As a former physiotherapist who transitioned full-time into financial education, he has built one of the internet's largest personal finance communities. And because of that daily direct interaction with hundreds of thousands of people, he intimately understands the questions, the fears, and the exact mistakes that modern, younger retail investors make. He isn't preaching from some Wall Street ivory tower. He's talking directly to everyday people who just want to know what to actually do with their savings. And get this, the book comes with high praise from the famous Big Short investor Steve Eisman. That establishes immediate credibility, framing this guide as the rational alternative to all that financial social media toxicity. When legendary investors step up to endorse a book aimed at 20 and 30-somethings, you know the framework inside isn't just a gimmick. It is about rewiring your brain to think in decades rather than days. Honestly, if a renowned investor who literally made his career betting against a rational market hype believes in this framework, it is absolutely worth our undivided attention. Moving on to Section 2, mastering your investing psychology, or as I like to call it, the fact that the enemy is you.
So before we pick a single stock, we absolutely must confront behavioral finance. A solid financial baseline is required before you invest a single dollar. And by that, I mean prioritizing your emergency fund and managing high-interest debt first. Once you're actually in the market, your biggest threats aren't bad stocks. They're your own cognitive biases. These biases are essentially glitches in our brain that cause us to make totally irrational decisions under stress. It's that urge to panic sell when the market dips and everything on your screen is flashing red. It's the greed when your neighbor won't stop bragging about a massive crypto win and you suddenly feel left behind. And maybe most importantly today, it's the temptation to constantly tweak your portfolio just because the frictionless app on your phone makes it incredibly easy to swipe and overtrade. To succeed, you literally have to conquer your own brain first.
To actually prevent these behavioral mistakes, the book outlines this strict 4-step chronological framework, functioning as a 2-track hybrid methodology. First, you get prepared, both financially and psychologically. Second, you lay a passive foundation. Only after that safety net is permanently built do you actively hunt for bargains. And finally, you learn the maintenance required to stay the course without obsessively monitoring your screen all day. It is so crucial to follow these chronologically, guys. You just cannot jump into hunting for bargains if your psychological foundation is weak. Which leads us perfectly into Section 3, the passive ETF foundation, setting up the wealth machine. Van der Kolk is super insistent here. Everyone must first build a boring set it and don't wreck it foundation. This means utilizing passive ETFs. Now, for anyone new to this concept, an ETF, or exchange-traded fund, is essentially a massive basket of stocks. So instead of trying to guess which single company is going to win, an ETF lets you buy a tiny slice of hundreds of companies all at once. This broad market exposure comes at a very low cost and acts as your automated wealth builder. It protects you from your own worst instincts and ensures that at the absolute bare minimum, you are reliably capturing the overall growth of the stock market over decades. And this naturally brings up a huge debate that's happening right now. With so many gurus out there preaching just buy the S&P 500,
Is individual stock picking just a massive waste of time and an unnecessary risk? A lot of finance voices today argue that picking stocks is entirely pointless for the average person. They believe the market is way too efficient and the odds are just stacked against retail investors. But the new money strategy takes a much more nuanced stance here. It argues that while your foundation absolutely must be passive, there is still incredible, life-changing opportunity out there if you know exactly where to look.
And that brings us to Section 4, Hunting for Buffett's Bargains, the active value layer. The beauty is you don't actually have to choose extremes. You can layer active stock selection right on top of your passive safety net. Here, van der Kolk adapts the legendary principles of famous value investors specifically for today's retail market. He takes the philosophies of Warren Buffett, Peter Lynch, Guy Spier, and Mohnish Pabrai, men who built incredible fortunes not by trading rapidly but by patiently buying deeply undervalued companies. Value investing is simply the art of buying a dollar for 50 cents. The author takes these classic, time-tested methods and translates them for a generation that is completely overwhelmed by 24/7 financial media noise and complex tech stocks.
And what we're looking for here are multi-baggers. Capturing these massive upside multi-baggers is the true engine for accelerated financial freedom. A multi-bagger isn't some overnight meme stock spike or a super risky bet on an unproven startup. It is a highly profitable, deeply entrenched business that you hold patiently while it multiplies your initial investment 3, 5, or even 10 times over. Achieving this requires immense patience and years of holding, not days. But this outsized return is the ultimate reward for doing the hard work of active value investing and tuning out the daily market panic.
Let's look at Section 5, the 3 moat tests, and how we actually evaluate competitive advantages. So, to find these multi-baggers without simply gambling, we have to systematically evaluate competitive advantages, otherwise known as moats. Think of a business like a castle. A moat is the protection that keeps competitors from storming in and stealing the profits. Van der Kolk splits the evaluation of the management running that castle into 2 distinct parts. First up is absolute integrity. Are the executives playing the same long-term game that you are? Are they fully transparent with shareholders in their annual letters? Do they openly admit their mistakes rather than hiding them under some complex accounting trick? Without this fundamental honesty, any competitive advantage a company has can easily be squandered by self-serving leadership.
But here's the kicker. Integrity is completely separate from talent. Talent focuses entirely on operational success and capital allocation. And capital allocation simply means how effectively management decides to spend the cash the company generates. Should they reinvest in new factories, pay down their debt, buy out a competitor, or maybe issue dividends back to the shareholders like you? A CEO might be the most honest, well-intentioned person in the world, but if they have a terrible track record of deploying cash and making bad investments, they are not going to build you a multi-bagger. To win big in active investing, you absolutely need leadership with both high integrity and exceptional talent.
And this brings us to the final, ultimate test. You have to systematically weigh that high-quality moat against current market valuation to ensure you aren't falling into an overpriced value trap. The logic here is strictly disciplined. If you find a high-quality moat trading at a bargain price, that is a clear buy. But if it's a high-quality business that is currently overvalued by the market, you must have the emotional discipline to walk away and avoid it. And if the business is low quality, well, it simply doesn't matter how cheap the stock is. You ignore it completely. This framework is exactly how you avoid confusing a quote-unquote cheap stock with a genuinely good investment.
So the ultimate question remains, can these timeless, patient principles of value investing truly conquer the chaotic 24/7 volatility of today's AI and crypto-driven markets? The new money strategy argues that not only can they survive, but rationality is the absolute only true edge you have left. In a market entirely driven by hype and algorithms, being patient is your superpower. As you consider how to apply this framework to your own wealth-building journey, subscribe so you don't miss an episode.